Okay, let's dive in. It's April 8th, 2025, and well, you've probably seen the headlines. Things look a bit shaky in the money markets. Stock prices took a real tumble, and yeah, that word recession is starting to pop up again. So for this deep dive, we're going to try and unpack all of that, help you figure out what's actually happening and, why it matters.
It's really unfolded quickly, hasn't it? The recent jitters really kicked off last week. President Trump brought in those new tariffs. It was, what, 25% on goods from China and then another 10% on imports from some other big countries. And the market reaction was, well, immediate.
Immediate is right. Stark even. The S&P 500, that big U.S. stock index, it really got hammered. A 6% drop on April 4th, and then bam, another 5% down the next day, April 5th. That's the worst fall we've had since the whole COVID mess, wasn't it?
Exactly. The worst since the pandemic uncertainty. It definitely got everyone's attention. And it brings up some really fundamental questions, right? If you're trying to make sense of it all. Things like, okay, what is a recession in simple terms? And does a big stock market drop automatically mean a recession is coming? Is that link definite? And maybe most importantly right now, what does this specific drop, the one tied to these tariffs, potentially signal for the wider economy?
Right. Let's start there. That word recession, we hear it thrown around a lot. But strip away the jargon. What does it actually mean for, regular people?
Well, think of it like the country's whole money-making machine just slowing down significantly. And not just for a week or two, but for, more than a few months. It's like the engine starts sputtering. So what happens? People get nervous about their jobs, their savings. So naturally, they might start spending less, be more cautious, and businesses. They see demand dropping off, so maybe they invest less. Maybe they slow down hiring. Or, worst case, start laying people off.
Ah, okay. So it's kind of a chain reaction. Less spending, less business activity, potentially fewer jobs. That makes sense. Is there a more, official definition, the one economists point to?
Yes, there is. The sort of standard technical definition you often hear is 2 consecutive quarters, so that's 6 months back to back,
Hmm.
of decline in something called GDP, gross domestic product.
GDP, right, the value of everything the country makes and sells.
Exactly. All the goods, all the services, cars, food, tech, healthcare, everything. Adjusted for price changes, of course. So if that total value shrinks for 6 months straight, that's a pretty strong sign the economy is contracting. That's the technical flag for a recession.
Okay, 6 months of shrinking GDP. Got it. But I've also heard there's this group, like an official body that makes the call in the U.S.
Ah, yes. You're thinking of the NBER, the National Bureau of Economic Research. They're kind of the recognized authority in the U.S. for saying, okay, a recession started then and it ended then.
Hmm.
What's interesting is they don't just look at that GDP number.
Oh, what else do they consider?
They take a much broader look. They look at things like employment figures.
Yeah.
Is unemployment rising? Are more people filing for jobless benefits? They look at industrial production. Are factories making less stuff? And really importantly, consumer spending. Are people actually buying things? Retail sales, personal income, that sort of data.
So they're piecing together a bigger picture of economic health, not just one number.
Exactly. It's a more holistic view. And because they're looking at all this data, which sometimes lags a bit, their official announcement often comes, well, quite a while after the recession actually began, maybe months later.
Right, so they confirm it after the fact, based on all that evidence.
Precisely. Which brings us to right now, April 2025. With the stock market doing what it's doing, everyone's looking very closely at all these indicators, jobs, spending, production, and, waiting to see what the NBER eventually decides.
Okay, that clears up the recession definition. Now, back to the stock market. We've seen this big drop. You said nearly 19% off the February high for the S&P 500. Does a drop like that automatically signal a recession is unavoidable? Is there a magic number, like that 20% mark?
That's the million-dollar question, isn't it? And the short answer is no, not automatically. When you get a drop of 20% or more from a recent peak, that's what we technically call a bear market.
Mm-hmm.
And you're right, 19% down from the February 2025 high, the S&P 500 is knocking right on the door of bear market territory. Very close.
Yeah, feels like it if you've glanced at your 401k lately. So, okay, a bear market can be a warning sign, but it's not a guarantee.
Exactly. Think of it as correlation, not necessarily causation.
Yeah.
It's a signal, but not a perfect predictor. Historically, yes, big market drops have sometimes come before or during recessions. You mentioned 2008, the Great Recession. The S&P 500 fell over 50% then, tied to the housing crisis. That was a huge economic problem reflected in the market.
Mhm.
Or think about 2020, the start of COVID. The market dropped what, 34% really fast as everything shut down. Again, clearly linked to a massive economic shock.
Right, those examples seem pretty clear-cut. Market down, economy down.
But doesn't always work that way. There are counterexamples. The classic one is 1987, Black Monday. The stock market crashed, dropped 22% in a single day. A huge, huge drop.
Wow, 22% in one day.
Yeah, way bigger percentage-wise than what we just saw over 2 days. But guess what? The broader U.S. economy did not tip into recession afterwards. It shook things up, sure, but no recession followed immediately.
Huh. Okay, so that really shows it. A crash doesn't always equal a recession. Other things have to be going wrong, too.
Precisely. Other underlying economic fundamentals matter a lot, which is why we need to look closely at this situation.
Right. This current drop seems so directly tied to these tariffs. Let's really dig into that sequence. What exactly happened?
Okay, so the timeline is pretty compressed and, frankly, escalatory. We had President Trump's earlier tariffs, remember? Like 20% on some Chinese goods already in place. Then April 2nd, this year, 2025, he announces a big new one, an additional 34% tariff, specifically on Chinese imports. He called it Liberation Day, framing it as a punishment for unfair trade and, importantly, the fentanyl issue. So that brings the total tariff on those goods up to 54%. That's a big jump.
54%. Wow. Okay. And China's reaction was?
Swift and pretty forceful. 2 days later, April 4th, China hits back. They slapped their own 34% tariff on all goods coming from the U.S. They called Trump's move bullying, a breach of trade rules. And interestingly, they also announced they were halting sales of certain rare earth metals, samarium and yttrium.
Rare earths, aren't those used in like electronics and defense tech?
Exactly. Really crucial for a lot of U.S. high-tech manufacturing and military hardware. So a significant counterpunch there.
Okay, so things were already pretty tense. Then the U.S. administration doubled down.
It seems that way. Fast forward to April 7th. President Trump uses Truth Social. He posts this ultimatum. If China doesn't drop its new tariffs by the next day, April 8th, the U.S. will impose another 50% tariff on Chinese goods.
Another 50%. On top of the 54.
Yep. That would bring the total U.S. tariff rate to a staggering 104%. Imagine that. Basically doubling the cost of those imported goods overnight.
104%. That would make those goods just incredibly expensive for Americans. So what did China say to that? April 8th comes.
They didn't blink. April 8th, China's Commerce Ministry comes out with a statement. They vow to fight to the end, rejecting what they call blackmail. Pretty strong language. And then just today, April 9th, Reuters is reporting that China is considering raising their tariffs on U.S. goods even higher, possibly to 84%.
84% from China.
And, they're also reportedly thinking about selling off some of their holdings of U.S. Treasury bonds.
Selling U.S. debt, that sounds like it could cause ripples way beyond just trade, couldn't it?
Oh, absolutely. If a major holder like China starts dumping U.S. Treasuries, that could push up U.S. borrowing costs, shake investor confidence. It's a serious potential financial weapon.
Okay. So this escalating tit for tat is clearly what's driving the market fear. We saw the S&P drop again. What else happened in the markets?
Well, we also saw oil prices fall quite a bit, back down to levels we haven't seen since the pandemic lows.
Why oil?
The thinking is pretty straightforward. A full-blown trade war between the world's two biggest economies, that would almost certainly slow down global economic growth. Slower growth means less demand for energy, less demand for oil.
Sure.
So prices drop on that expectation.
Gotcha. Okay. Tariffs flying, stocks falling, oil dropping. How do these pieces connect to actually cause a recession? What's the mechanism?
Right. This is where it gets interconnected. As we touched on, falling stock prices can really hit consumer confidence. You see your retirement account shrinking, maybe you feel less wealthy, less secure. So you pull back on spending, right? Especially in bigger purchases.
Yeah, makes sense. Less confidence, less spending.
And that reduced spending hits businesses. Sales go down, profits shrink. On top of that, if a company's stock price is lower, it might be harder or more expensive for them to raise money, by issuing new stock or borrowing.
So they might cut back on plans, hiring, investing.
Exactly. They might freeze hiring, delay expansion projects, maybe put off buying new equipment. And if things get bad enough, yes, they might resort to layoffs to cut costs. And that creates this negative feedback loop, you see. Less spending, less business, job losses, even less spending.
And the tariff war just pours gasoline on that fire because of all the uncertainty.
Precisely. It's the unpredictability that's so damaging. Businesses hate uncertainty. If you import parts or sell goods overseas, you certainly have no idea what your costs will be or if your markets will be open. So you pause. You wait and see. You don't make big investments. And consumers, they worry about prices going up on everything from electronics to clothes because of tariffs, so maybe they also pause their spending. It just chills activity.
Okay, so given all this, what are the experts actually saying now? What's the probability we're heading for a U.S. recession?
Well, the odds are definitely being marked up. Goldman Sachs, for instance, they just raised their probability of a U.S. recession in the next year. They had it at 35%. Now they're saying 45%.
Yeah.
And they point directly at this tariff fight as the main reason for the increase.
45% from Goldman. Okay. Anyone else?
JP Morgan is reportedly even more pessimistic. They're apparently putting the odds at around 60%, specifically because of the trade war impact.
60%. Yeah.
And Forbes chimed in too, suggesting maybe a 65% to 80% chance by the end of this year, 2025. Their reasoning focuses on higher prices from tariffs hitting consumers, plus the drag from reduced global trade overall.
So pretty high probabilities from several major sources. Are they quantifying the potential damage?
Some are trying. Goldman warned the trade war itself could shave maybe almost 1% off U.S. GDP growth. And they're worried about consumer spending really weakening if prices keep rising. And looking globally, Citigroup put out an estimate suggesting China could lose up to 2.4% of its GDP growth because of this. So significant impacts expected on both sides.
That sounds pretty bleak.
Ow.
But are there any bright spots, any reason to think the U.S. economy could maybe weather this storm?
Well, it's not all doom and gloom yet. There are still some strengths.
Right.
The U.S. unemployment rate is still relatively low, right? 4.2%. That suggests the job market hasn't buckled yet.
Sure.
And consumer spending, while maybe slowing, hasn't collapsed. People are still buying things for now. Plus, we've had recession scares before that didn't pan out. Remember all the talk back in 2023? Didn't happen then. So yes, the risk is clearly higher now because of the tariffs, but it's not a locked-in certainty.
Okay, fair point. Predictions are tough. So if we're trying to track this ourselves, what are the key things to watch in the coming weeks or months? What indicators matter most?
Good question. There are a few key things. One is that inverted yield curve we sometimes hear about. That's where short-term borrowing costs get higher than long-term ones. Parts of the curve have been inverted since 2022, actually. Historically, that's been a pretty decent, though not perfect, recession warning sign. So keep an eye on that.
The yield curve. Okay, what else?
Consumer confidence surveys. Those are crucial. If people start getting really pessimistic, likely because they're worried about tariff-driven price hikes, you'll see it there first. And that usually leads to less spending.
Makes sense. Watch how people are feeling.
Yeah. And obviously, keep watching the trade developments themselves. China's response is critical. If they actually go ahead with that threatened 84% tariff on U.S. goods, that would be a major escalation with big consequences.
But there's still a chance they could back down or negotiate.
Absolutely. There's always a chance for an off-ramp. If the U.S. or China signals a willingness to talk, to find some kind of deal, that could calm markets down significantly and maybe avert the worst-case economic scenario. Diplomacy is still possible.
Okay. So navigating this uncertainty, what's the practical advice for businesses, for individuals listening right now? What should they be thinking about?
Right. Super important. Let's break it down. For businesses first, the big theme is building resilience. That means saving cash. Try to get a buffer, maybe 6 to 12 months of operating expenses possible. Pay down debt, especially anything with a high interest rate. That frees up cash flow. Think about diversifying. Are you too reliant on one market, maybe China? Can you find other suppliers or customers? Lessen that trade exposure.
Diversify.
And plan for potentially lower sales. Run some scenarios. What if revenue drops 10%, 20%? What steps would you take? And finally, look at costs, but strategically. Cut non-essential spending, sure, but try not to sacrifice things vital for long-term growth if you can avoid it.
Solid advice for businesses. Building that cushion, having a plan. What about for individuals, families?
Similar principles, really.
Yeah.
First and foremost, that emergency fund. More critical than ever. Aim for, say, 4 to 6 months of essential living expenses, somewhere safe and easy to access.
Emergency fund, got it.
Then tackle high-interest debt, credit cards, personal loans. Getting those paid down gives you breathing room. Investment-wise, maybe consider if your risk tolerance has changed. Some people might look at safer havens like bonds or maybe even gold for a portion of their savings, but that's very individual.
Yeah, it depends on your situation.
Definitely. And think about income streams. Can you upskill, pick up some side work, anything to boost financial security? And the obvious one, just be mindful of spending. Track where your money's going. Maybe cut back on non-essentials to free up cash for savings or debt repayment.
So preparedness is key across the board. Build savings, cut debt, be mindful. But you also mentioned staying informed without panicking.
Exactly that. It's a balance. Stay aware of the big economic news, job numbers, inflation reports, because that context matters for your planning. But please, try not to make rash decisions based on fear. Like, don't suddenly sell all your stocks just because the market had a bad week. That's usually a losing strategy long term.
Yeah.
Remember, economic downturns happen. They're part of the cycle. They don't last forever. Thoughtful preparation is the best way to ride them out.
Okay, let's try and wrap this up. Key takeaways from today's deep dive. We're in a moment, April 8th, 2025, with definite economic jitters. It's driven largely by this escalating US-China tariff war. We defined a recession, basically a big economic slowdown, technically often marked by 2 quarters of shrinking GDP, but officially called by the NBER using broader data. We talked about stock market drops, like the one we just saw. They can be a warning sign for recessions, but they aren't a guarantee. History shows that. Remember 1987?
Right. Correlation, not perfect causation.
Right. The current trigger seems clearly to be these tariffs. U.S. tariffs on China potentially hitting 104%, China retaliating maybe up to 84% on U.S. goods. That's created huge uncertainty.
And pushed up the perceived risk of a U.S. recession significantly, according to many experts. Though, it's still not certain.
Exactly. Still not certain. And the advice for listeners, businesses,